Welcome, welcome, welcome. The big question has been, all right, what's open? What's not open? What are we doing today? What aren't we doing today? Well, guys, everything um, equities, I believe, closes at 8:30. You've got about a 30-minute window on the Nasdaq and the S&P. But it looks, if I'm not mistaken, like gold and crude are going to continue to trade throughout the day. Energies, FX, metals. So there may be some stuff for you guys to do. Good morning, Gary. Good morning, Luciano. Certainly, we'll have stuff to do in this classroom. I never run out of stuff to talk about. I can flap my gums incessantly. Replay then Jim. I like it. I'm going to play with you guys for a little bit, and then I'm going to do some study. And then I'm getting a lot of work done on the funding company and gathering stats and all that fun stuff. It has been a busy, busy morning already, and I anticipate a busy, busy afternoon. So always something to do. Might have to take a break for sushi somewhere in there. Guys, every morning and everything we're doing, I'm looking, do I have my new folks back or did I scare everybody away yesterday? Hopefully you got some of you back here. Simplicity. What a great word, right? Simplicity. Hey, New York City, I like it. You guys are tough up there. You're not going anywhere. Guys, I'm going to break this down as easy as I know how to do it. And one of the things that John Novak used to say 20 years ago, when I told him that this was way too complicated for me, he used to say, Mark, you don't have to know how to build a watch to tell time, and you don't have to understand internal combustion to drive a car. And that's kind of my approach to this classroom, guys, is you don't have to know how the indicators come to be. You don't have to understand what it takes to create Fibonacci projections and alternates. We're just going to focus on some patterns that have been proven to win more than they lose, how to recognize them, and how to capture them as trades. So clear your brain of all the thoughts. You engineers, put your spreadsheets and slide rulers away. We're gonna break this down. Hey, Chef, good to see you in here, man. So today is Thursday, January 9th. Most of you know that today is a day of mourning for Jimmy Carter, the passing of the ex-president. And a lot of markets are closing, but there's still news releases today. A lot of FOMC chatter going on. None of it's considered high impact, so it's really pretty mellow today from a news point. But I check that every morning because I'm about advantages. Everything I do revolves around advantages. And if I know when there is a high impact or a medium impact news release, I also know that that can make the market trade very erratically, and that can make the market spike and jump, can pull me out of a great position. So I choose not to trade whenever I see these high impact or medium impact. I know there's different schools of thought on this, guys. I prefer to keep it on U.S. markets only. Those are the ones that I trade. It just keeps some of the clutter out of my brain. Again, simplicity. Everything that we talk about comes from the Nexgen page, the Nexgen Fibonacci day trading software page, specifically the trading guide. And hey, good morning, Jay. I was talking to Chris Novak yesterday, and we were just going through, man, how do we do this? How do we do this? What do you think? What do you think? I am on a hell-bent mission right now to create a 1 to 2 page document that teaches you how to catch this high probability trend trade. Guys, there is all the information, all the answers. Every question you have gets answered on this page. But today we're going to break it down and we're going to keep it even more simple than this. This is like having the Encyclopedia Britannica on the shelf. Every answer you could ever hope for. But we're going to look at the stuff that's pertinent to what we're doing. And we're going to do it by focusing on one trade for the first hour of class, maybe longer since the markets may or may not be giving us anything today. We are going to focus on what's called a high probability trade. And this is a trade when each indicator on every chart agrees for the rules for the trade, guys. This is the best of the best. This is the easiest trade to recognize. This is a trade that typically wins 70 to 80% of the time. if you follow the rules. There's the key there, right? You have to follow the rules. So we're gonna break down the rules. This is a trade where you have the strongest triggers that you could ever have, and this is where there's absolutely nothing in the way between you and your target. And guys, this is the trade that typically wins 70 to 80% of the time. There is this old adage that says that confidence comes from the memory of success. Guys, being successful 70 to 80% of the time creates a boatload of confidence. But the most important thing that this trade does for you, and this is really my goal every day, is to teach you how to read your charts. Learning how to read your charts, how to look at those indicators and understand what they're telling you. Understand whether or not you have that advantage in place, so that you know that it's time to take a trade. Reading your charts, chart reading, is about 90% of your day. If we took 6 hours every day of the week and watched the markets waiting for our rules to be met, you would find that about 36 minutes a day are spent actually trading, and the other 5 hours and 24 minutes are spent waiting for advantages to come into place. And you've got to believe in your heart of hearts that your money is worth being patient. Your money is worth waiting for those advantages. And as a brand new user, we're going to give you the best of the best. And what you're going to find is that once you understand the best of the best, you'll be able to find more. You'll be able to see more opportunities. You'll be able to manage a little more aggressively, a little differently, holding for bigger moves and finding more profits. But we're going to build this outstanding foundation first, guys. And it starts with the high probability trade. Once you get good at this, reading your indicators, and it doesn't take long if you put a little work in, guys, you're going to understand where the market is likely to continue. This continuation point, this is where you're entering that highest probability trend trade. That likely to continue references the point where that established trend is most likely to continue in the direction that it has already told you that it's going. You will understand where it's likely to go, and this is going to work its way into your management. You're going to be able to see these Fibonacci areas in the distance and say, man, with these advantages, that's where that market is likely to go. Let's let it get there. And then finally, you're going to understand where the market is likely to stop. And likely to stop is what we call a termination condition. You're going to know about these places long before you get to them. And these are areas that can stop the market and create untradeable bounces and really pull you out of your good time. So your chart reading is going to tell you when you have the advantages you need to enter the market. And guys, those advantages come from the three very simple rules of the high probability trend trade. Quick pause. Miss Anna, how is your husband out in LA? Is everything okay? I woke up thinking about that this morning. I hope. I don't know if you can hear me. I don't know if your speakers are on. Guys, the high probability trend trade is 3 rules. That's it. And each rule gives you an advantage. The first rule says strong triggers. And when you have strong triggers, you have the advantage of momentum down here in yellow. The second rule says termination's false. That means don't trade into any of those areas that might stop the market. And when that rule is true, you have a clear path. Now, ladies and gentlemen, I'm going to let you in on a secret. Once you understand momentum, you can identify it. Once you understand clear path, it just pops off and you see it. Guys, you have everything that you need to create a very successful and very consistent trading plan. In the beginning, we focus on these 3 rules because they really get you in tune with the market. They slow it down a little bit. And your third rule, using that limit order to enter at areas, gives you the advantage of entering the market where the market is most likely to continue. So a trade isn't your need to pay rent or your desire for a Ferrari. And trading isn't about putting the kids through college, guys. A trade is nothing more than the accumulation of enough advantages to put you in a position where you're trading a pattern that has been proven to win more than it loses. So a trade is momentum, clear path, and entry. And just like if you're baking a cake, if you omit something from the recipe, you're going to find yourself with different results. So we're going to focus real hard on these first 2, and you're going to find them on the large chart. Only 2 charts to find these 3 rules. Guys, the large chart is going to define the direction of the market. It's literally going to tell you which way you should be trading. Should I be going up with the market? Should I be trading down? And we talked about that yesterday, and this is one of the advantages of trading the futures markets, is you can make money whether that market is going up or down. There's opportunities on both sides of the coin. And your large chart will tell you which way those opportunities are coming. Next, your large chart, and guys, this is using one bar, the most current bar, will define the momentum in the market and let you know whether or not that first rule has been met and that first advantage is in place. And the large chart will also define the areas that you may be trading to, that you might be trading from, areas that can become problematic, and talking about those termination conditions. And that's rule number 2. So your first 2 rules are given to you from one bar on the large chart. 2.5 miles. Oh my gosh, Anna, that's terrifying. I'm so glad everybody's okay. Good stuff. I woke up thinking about that. I saw a little clip on the news last night, and I woke up and I told my wife, I was like, Anna's husband's in the line here. I hope he's okay. So good. Sorry guys, little digression there, but we're human. Once the rules are met, once you have momentum, once that path is clear, it sets off the green light, and it's let's look for an entry. And that's where the small chart comes in. On this small chart, from that one bar that gives so much great information, it's literally going to refine it. It's going to break it down into 15 to 30 bars. And it's this refinement process that allows you to pinpoint precisely where the market is most likely to continue. And it's that refinement process that reduces risk. And it's that refinement process that increases your profit potential. So rule number 3 is a small chart endeavor. You're going to take that little faster chart and use a lot of precision. We use 2 charts because they really define who you're trading with or who you're trading against. Your large chart is the big crowd. This is one of my favorite analogies because visually this speaks to me. There are men and women with the power, the influence, and the money to make the market do what they want it to do. If they want it to go up, it goes up. And if they want it to go up fast, they create momentum. And if they see one of those key areas, well, they might take their position off. They might fight with the opposing side right at those key areas. You have the ability to see everything that these guys are thinking. And they should lead the way. You should be trading with the large crowd. That's where your highest chance of success comes in. But there is a small crowd. And these are the guys that sat in the back of class, put their motorcycle boots up on the desk, and defied authority, right? These guys fight the large crowd, and they create these little retracements. We're going to use rule number 3 for the high probability trend trade on that smaller, faster chart to pinpoint where they're most likely to fail. And they typically fail 70 to 80% of the time, which means that when we're entering at their failure point, we have the potential to win up to 70 to 80% of the time. So it takes 2 charts, but it only takes 3 rules. And if you keep it very focused, you're going to find that you can do this, and you can do this quickly. So we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. That's the core of the first hour, is just breaking the rules down. What do they look like? How do I recognize it? Where do I find it? And what does it mean to me? And that's kind of the goal. You guys have the ability to simulate. If you're on demo, if you lease, if you own, you can simulate, you can practice, guys. Simulator is it's your golf range. It's your batting cages. It's shooting free throws, guys. It is a 100% zero consequences arena for you to get good so that when it's time to perform, you're ready. The step-by-step path to becoming confident, ASAP, the first thing is posting your trades in class. So as you work on Simulator, ask for feedback. Every time you post in the room, what happens is you get a private session with me. We talk about your chart read. So it's important that you write on your chart the momentum that you see or don't see. It's important that you write on your chart the termination condition that may be in the way, or maybe the clear path that you see. And it's really important that you show me where you've gotten in and where you've gotten out, guys, because what you're going to find is there is a lesson in everything that you write on this chart. Sometimes the feedback is, hey, perfect, you did it better than anyone I've ever seen. Sometimes we talk about trigger locations to make sure that you really understand momentum. But when you tell me what you see, it lets me know where you're at in the education process, and it kind of lets me tailor make my lessons to get you where you need to be. They all become very specific for you. So don't forego that private session. I'm here 15 hours every week to give it to you. We're going to simplify. We're going to focus on that high probability trend trade. We're going to break it down. Repetition creates recognition, guys. Repetition builds the brain, and it slows things down, and it makes it easy. So I say the same thing over and over and over, and I'm going to encourage you to study through repetition as well. You've got to learn the looks. You've got to know what it looks like, because once you know what the pattern is, it becomes easy to catch. And then once you trust the pattern, you will refuse to miss a trade that fits those rules. And that's the second piece of the puzzle to getting to where you want to be. Use the spreadsheet that Nexgen provided you when you downloaded the software, guys. Use the spreadsheet that I'm dropping in the room right now. It's in there. You can slide it over to your desktop. You can download it, but use this spreadsheet, because the spreadsheet is 4 tabs of wholesome goodness, guys. And the first tab is your trade tracking sheet. So every time you take a trade on Simulator, I want you to annotate it. I want you to talk about momentum. I want you to talk about path, and I want you to circle entries and exits, because what you're going to do is you're going to drop that picture right into your spreadsheet. You're going to talk about the advantages. You can put in whether you win or lose. That doesn't matter to me. But this feedback from class, this is where it's going to pay dividends, because the feedback may be that it was a perfect entry, never missed this setup. Or the feedback may be repeatedly that you traded into a termination condition, that you fought triggers, that you went against the trend. And what's going to happen is you're going to come back and study this sheet every morning. It's going to take 3 minutes of your life. And that 3 minutes is going to have you recognizing what worked and what didn't work. And that 3 minutes is going to help you recognize the patterns that are helping and hurting. And that feedback from class, guys, you're going to notice a pattern. You're going to notice your thing. And that's one of the things that I've gotten really good at over the years. If I get 3 to 5 pictures from you, I'm going to know what your thing is. I'm going to know what your tendencies are. And guys, I have broken every rule and made every mistake with this software that you could ever make. And I've worked through it with my mentor how to fix it. And I'm going to give you the exact same thing. So if you show me what you're doing and it's not 100% where it needs to be, I have a fix. All I have to do is see your charts. The second tab is the very basic rules of the high probability trend trade in green, what it means to have them met visually, and I guess not really orally, we're not speaking, but every one of these pictures is annotated. Every one of these pictures not only points out what it means to have strong triggers, but it describes it in detail, exactly what it means to have that rule met. And then the red tabs are what it means to not have it met. Because if your goal is to trade with advantages, if your goal is to follow rules, to stick to the plan, you need to know what it looks like when your plan is met, and you need to know what it looks like when your plan isn't. And I'm going to give you a sheet that's going to put you to work taking these pictures. And the more pictures you take, the quicker you're going to get to where you want to be. There's the client trade section. Up here in the light blue is what it looks like to take a high probability trend trade step by step, from deciding to take that trade until you actually enter. There is a very mechanical management plan here, and this will be given to you in a Word document as well as PDF. There are about 380, I don't know, a lot, maybe 380, almost 400 pictures that I've stolen from the men and women that participate in my class, because you're doing great things with the software. I steal them so that other people can learn from them. You NASDAQ traders, I start to put some ideas in here on it. Just a heads up, the NASDAQ moves about 10 to 20 times faster than the S&P and crude oil. And it's easier to learn these patterns on crude oil and S&P. This morning we're going to have crude oil and gold up because the S&P's closed with the Jimmy Carter thing. The management plan, and then ideas on when you can manage differently, when you can hold for bigger moves, when you should get out a little sooner. And then the coolest thing ever is, once you're a chart reader, you're going to begin to recognize patterns. You're going to begin to see things that seem to happen every day. And you're like, oh my gosh, I've seen this and this was the result. And then you're going to say, oh my gosh, I've seen this 100 times and 80% of the time the result's the same. And guys, these patterns are going to work their way into your trading plan as you begin to recognize them. I encourage you guys, if you begin to recognize a pattern, drop it in the room. Let's talk about it. And then the final tab is building your trading plan, your personal trade setups, guys. This is where you're going to have a visual of what it means to have your patterns in place. This is where you're going to work on your management plan. This is where you're going to begin to put the pictures of those patterns. And then the most important thing that I can tell you guys over and over is you don't have to do it alone. John put something in the room a couple weeks ago, and he said don't update because it was creating problems, and I'm not sure where the problems were coming from. But I do know as of about 2 weeks ago, he was saying just skip that update. No worries. So our morning is going to revolve around learning the trigger line and the Fibonacci rules, guys. Your job is to simulate and post in the room. And if you're not taking trades, take pictures of why you're not taking trades and write that on a chart. Hey, I don't have momentum yet, chose not to trade. This is into a line, I chose not to trade. I didn't have an area inside of favorable large triggers, I chose not to trade. And guys, those pictures create exactly what you need. The S&P was the other one, the ES, Stephen, that I was talking about. So one of the great things about the software is these patterns show up, and it doesn't matter if it is futures. We have people that use it for stocks, Stephen. My wife has crypto accounts, and I build charts for her and her crypto accounts for key areas. But I use the S&P and I use crude oil in this room primarily because they tend to flow very well. They tend to not move too fast to be able to pick up, and they really do provide a lot of opportunity each and every day. We're going to go through these rules and we're going to break them down individually. And that's what we're going to do. So we're going to talk about rule number 1, and we're not going to talk about trading with rule number 1. We're not going to talk about management with rule number 1. We're not going to talk about anything other than what it looks like to have rule number 1 met, guys. And rule number 1 is strong triggers. Because strong triggers give us momentum. They give us that first advantage that we're looking for when it's time to look for a trade. And in order to have strong triggers, you will have to trade with the trend. Little safeguard there. And the trend is the easiest lesson. And like I said earlier, in futures, there's money to be made in an uptrend when the background is green. And there's money to be made in a downtrend when the background is red. The rules are the same either direction. The colors are a little bit different. So if my background is green, I'm looking for rules to be met for high probability trend trade. If I am in a downtrend, I'm looking for rules to be met for a high probability trend trade short. Rob, I'm not sure why it would be grayed out, to be honest with you. Just let's do a quick little... Mine is not grayed out. Are you sure you're connected to data? That would be the first place that I look. Make sure that you are actually connected, that you have that green light, or the little green ball, whatever you call it, dot. There we go. You should be connected. You should have a green light. If you don't have that, that might be part of the problem. Once you've looked at your background color and you've established the trend and you've said to yourself, I need to look for momentum up because the background is green, it's pretty easy because momentum is defined by the trigger lines, and your trigger lines will have to be green as well. So these are small trigger lines, guys. These are solid lines. They're a fast moving indicator. And these are large trigger lines. They're dashed lines. These are a slower moving average. These work together to let you know that you have that advantage of momentum. So when your small triggers break up and above the large triggers, when your large triggers are wide, they're angled in the direction of the trend, you'll see the separation, the space between the two. And it's that separation. I want you to picture scissors that are opening. That separation lets me know that the odds are favorable for the market to continue up. And then, of course, we have the exact same look going the other way, going down. And this lets me know when the small triggers are below the large triggers are wide, and I have separation. I have space between those trigger lines. This lets me know that the odds are favorable for the market to continue down. Guys, odds favorable momentum. You're going to hear it in class all day long. Odds favorable momentum. You're going to see it annotated on charts, OFM. Odds favorable momentum pushes a market in the direction of the trend. Odds favorable momentum can break key areas. Odds favorable momentum can even cover some of the mistakes that new users make. And I want you to see this picture right here. That is all you need to recognize strong triggers to the upside. That's it. It's the separation. So I have strength up and I have strength down. And guys, momentum is universal. Whether it is a large chart or a small chart, whether it's a range chart, it could be a month chart, a year chart, it doesn't matter. When you have the separation between the triggers, you have a market that's likely to continue in the direction of that trend. And that's rule number one, and that typically is one of the easiest lessons that you'll ever get. This is the gold market. There's odds favorable momentum to the downside, and sure enough, it rocked it all the way to the downside. And then there's odds favorable momentum to the upside, and oddly enough, the market continued up with all that momentum. Look at this, with those flat triggers, it's a little indecision. So odds favorable momentum is rule number one. It's strong triggers, and this is the one that pushes a market, guys. Are there any questions? Are we good with that one? Odds favorable, OFM. What's the opposite of strong? It's got to be weak, right? How do we know we have weak triggers? When the scissors close. When your small triggers work inside of the large triggers. This is a weakness. This is a visual that the trend is slowing. And when you have weak triggers, anything can happen up or down. The market may retrace deeper. It could reverse completely. Guys, that advantage of having that strong push is no longer there. And if you are a fan of language, the way I'm a fan of language, just the description. This is odds favorable strong. This is anything can happen weak. It becomes easy to commit to one look over the other. It becomes easy to embrace the advantage and really let go of when the advantage is gone. What you'll find is that throughout the day you will have both. Remember, 90% of your day is doing nothing. So you may have strong triggers that work their way into those weak anything can happen triggers. And sure enough, that's where the reversal happens. And then it may produce strong triggers. And guys, in that one bar, you're going to see these little tails sprout. Remember, this is a slow moving chart. This tail is that pullback, is that small chart, that small crowd fight on a smaller, faster chart. You're actually going to be able to pinpoint where these tails are most likely to form when your rules are met. And then it carries up to those anything can happen triggers again in another reversal. And then it pushes down into odds favorable momentum and maybe another tail. And then we get into the transition phase. This is where the large crowd buyers and sellers fight. And this is where the colors in your trigger lines don't match. This is where maybe you're larger red and you're smaller green and you don't have momentum. And maybe your background is green and your triggers are red and you don't have momentum. And this is where Nexgen users don't have to hope or try to predict what's going to happen next. This is that 90% where we sit on our hands and we say out loud, I don't have the advantages I need to take a trade. Let me wait for either the buyers or sellers to take over, to win, and to produce that momentum that I need, guys. So 90% of your day is going to be a whole lot of nothing. Of course there is. Of course there is. So Blue Pearl, remember, and Blue Pearl asked, are there instances where odds favorable momentum will not drive the market in the desired direction after it is spotted? What a great question. And what a great segue. So check this out. Even with odds favorable momentum, Blue Pearl, Fibonacci can stop it cold. And it's not uncommon to see the market railing with everything you hope for. And then it hits a line and it reverses. So one of the ways we can identify when that momentum may not be everything we need is through rule number 2, identifying termination conditions. And there's also times, let me go back to that large chart, and I want you to see this. Remember, Blue Pearl, that everything we do is patterns. Everything we do are patterns. And sometimes you'll have momentum and the area is not quite broken and it won't finish. There's a great example of momentum stopping cold at a fib. But sometimes, let me see if I can find one, you'll have that momentum and the market just seems to reverse. And this is the market reminding us that we're not in charge, that the market's going to do what the large crowd wants to do. So that's also why we have 3 rules in place and not just relying on momentum. Because sometimes even with momentum, the market can bounce up. But remember, we're focusing on a methodology that typically wins 70 to 80% of the time. So that means the accumulation of the 3 creates a statistical advantage. And momentum alone is great, but momentum with a clear path is better. Does that make sense? The market will not do what you want it to do all the time. And some days it just won't do it at all. But we can start to recognize patterns that have been proven that if I take that trade 10 times, I'm likely to win 7 or 8 of them. Good morning, Jeffrey Dean. So let's talk about those termination conditions that can stop a market with odds favorable momentum. When there's none present, I have a clear path. But when they're present, I have to pump the brakes because these areas on a large chart are where the market can stop. These areas on the large chart are where the market may reverse. These areas on the large chart are where the large crowd are most likely to make decisions. And ladies and gentlemen, you know about them long before you ever get to them. So these are the lines on the large chart, horizontal lines on a large chart that can behave as termination conditions, guys. We have divergence highs, which is a magenta line that prints off of a pivot if there's a loss of momentum at that pivot. And then the cyan line, the light blue line at a low, does the exact same thing. It lets you know, even though the market is screaming to the downside, there was a pivot and that momentum isn't following the price. Fibonacci resistance is a red line, and when the market is trending up, it can stop the market. It can create an untradeable bounce. Hell, it can reverse the market completely. Blue Fibonacci support has the same role going the other direction. So, Stephen Matthews, I want to remind you that we can make it up or down, and resistance in an uptrend is exactly the same as support in a downtrend. It's a line that can stop the market. Then we have these yellow 1-to-1s, and these are Fibonacci alternates, and they can act as support if the market is trending down, and they can act as resistance if the market is trending up. So these are kind of like fibs that print live during the day. It's that little extra safeguard. The idea with these areas on a large chart is that they may stop our forward progress. And if we're taking trend trades, we want to continue with the trend. So if the large crowd's making decisions at these lines, rule number 1 for identifying a termination condition is allow price to get to that area. Allow those price bars to reach Fibonacci resistance. Guys, if my price bars are here and my Fibonacci support is down here, I'm going to call Fibonacci support a target until price reaches that area. The same with resistance. But once price reaches that area, you have to ask yourself, where are my triggers? Guys, if your triggers remain below resistance, resistance is a termination condition. If your triggers remain above support, support is a termination condition. And then you have to wait for the reaction, because the reaction may be a big untradeable bounce. The reaction might be that seismograph fight right at the key area between buyers and sellers. The reaction may be no reaction at all and the area breaks, or the reaction could be a full reversal where those large triggers go from green to red and the market starts down. Guys, if you get a full reversal from resistance, that's a strong top. And a strong top is rule number 1 for 3 trades I can think of, and it's the precursor for the highest probability trend trade you could ever take. And a strong bottom, if it reverses, is the first rule for at least 3 trades, and it is the precursor for the highest probability trend trade that you could ever take. So let's take a look at this market that we were just looking at, and let's just talk about how effective these termination conditions are. Price pulls back to Fibonacci support. The triggers are unable to break through, and this is where the market continues up. Price reaches Fibonacci resistance right in the middle of the night, and that's where the start down happened. And even with that odds favorable momentum, there was a big retracement. And then Blue Pearl and Steven, do you guys see that big retracement? Came right to the one-to-ones, and then the market continued down right off of that area. Resistance creates a bounce. Divergence lows coupled with one-to-ones change the direction of the market. Here we are at resistance again. Here we are not getting those triggers through support. Right up to resistance, right down to support. Oh my gosh. You know about these areas. And guys, now you have a recipe to not trade into them. Rule number 2 is the most broken rule. Rule number 2 is the rule that more people break. Because rule number 2 is going to force you to be patient. Rule number 2 is going to force you to wait for the reaction. You'll never know what it's going to be. Ever. But there's opportunities coming from these areas. And guys, these areas break all day long. They really do. If they didn't, we'd be caught in this really tight range each and every day, and that's just not how the market works. So there is I did this. This is the life cycle of a Fibonacci area breaking. Can act on price even if it merely comes close. So Blue Pearl, what we want is we want price to reach the area. And I like this question. So Fibonacci areas, and I talked about this yesterday. Let me show you a picture here of how Fibonacci areas are born. Each and every Fibonacci area is born from thousands of calculations. Every swing in the market, every up, every down. And this is how many calculations produce fibs. And then the algorithm kicks in and it finds the concentration. So when I talk about Fibonacci support or resistance, and let me go to the live chart. When I talk about Fibonacci support or resistance, these lines come from thousands of calculations. So in my world, a tick or two below or a tick or two above, I'm going to consider it hit. That's me personally. These yellow one-to-ones are precise, 100%. And these yellow one-to-ones are 100% Fibonacci alternates, which means that when the market went up to here and down to here, your software instantly projects this distance, projects it in the distance. This is a 100% accurate number. I force the market to come in contact with these. Divergence highs and lows are a 100% no wiggle room number. I force the market to come in contact with these. So when we talk about the fibs, if you stop a tick short, Blue Pearl, in my world, that's close enough. And it also means sometimes it's going to go a tick over. And that tick over, there's a lot of new users that go, cool, we're on the other side of the fib, it's clear. But trigger lines define whether or not you have a clear path. Does that make sense? And then New York Pug, I don't know what a VPS is. Help me out. That sounds techie. A virtual computer that is on all the time. We have a server. I'm going to have to say no because I've never heard of that. My software is off if my NinjaTrader isn't open. We do have a server that runs the software that keeps your software active. That'll shut you down security-wise if there's shenanigans. But Nexgen doesn't have like a big virtual trading computer. We're an indicator company. We teach you to read indicators. We don't trade. I mean, we all trade our personal stuff. But there isn't a Nexgen trading group. Awesome. So guys, this is exactly how your life will go on terminations. So if price reaches, let's start right here. Price reaches support, all the triggers are above. This is a termination condition. I have no idea what's going to happen. But in this case, it happened to reverse the market. It's a strong bottom. Price reaches Fibonacci resistance. This is number one. And when price reaches resistance, everyone in this room asks themselves, Where are my trigger lines? And you'll notice that both the small triggers and the large triggers remain below resistance. Can you give me a Y in the room if you recognize this is the termination condition? This is the no more trades into that area look. And guys, this is every line. Every line that you reach, you're going to have to pause. Rob, where have you been for the last 10 minutes? This is where you have to sit on your hands and do nothing because you don't know what's going to happen. If your small triggers, oh, I was like, gosh, Rob, turn your volume up. If your small triggers smash through the area, remember guys, price reaching sets off the decision making, trigger lines tell the story. If my small triggers smash through the area, but my large triggers are still below, this area, as long as I have that momentum from rule number 1, this area has the potential to break. You can take trades with the potential to break, but you're only trading potential. It's not broken. It's not a clear path. Rule number 2 isn't met. You may have to manage assertively, and I promise you, you're going to need to rely on your ability to read charts to manage assertively. But when the small triggers and the large triggers, both lines of each, get above resistance, resistance is broken, your path is clear, and that path remains clear until you reach the next area. So every time you reach a line, there's different things that could happen. It could bounce, it could reverse, it could break. You never know. So that first one, sit on your hands and wait. It's either going to give you the potential for a trade or it's going to reverse the market. And then from that potential, it's either going to fail and not break or it's going to break. So there's 90% of your day, guys, doing nothing. In a downtrend, it's the same way. Once I reach Fibonacci support, I have to ask myself, where are my triggers? And if they're still above, it's a termination condition. I'm going to wait and see what the reaction is. If my small triggers smash through, my large triggers haven't made it yet, well, I might find an opportunity. It's what we call a 50-50 trade. And if small and large get below, my area of support is broken. It's behaving as resistance. I have a green light to look for that entry if I have momentum and that path is clear. And my path is clear until I reach the next area. And what you're going to find, guys, is each and every day, let's go to the large chart again. You're going to have 100% termination conditions. You're going to have times where you have a clear path. There's one of those pullbacks. That might have even been an entry that got you paid. And you will see that potential to break, but it doesn't. And you get that big retracement. Weak triggers is where the retracement happens. Strong triggers break through the area. But guys, you don't have a clear path. 1, 2, 3 areas. And by the time it's clear, you're already into the next term. And guys, this is 90% of your day. There will be times where you have stacked Fibonacci support. There will be times where you have stacked resistance. And you just simply are sitting on your hands wishing you were in a trade, wishing that you were getting paid. But what you're not doing is giving away money without advantages. So this is 90% of your day. But guys, there are days when the futures markets trade $220 billion hourly, trillions daily, hundreds of billions of dollars. And you only need to catch 400 of it each and every day to put yourself in a six-figure income. You don't need to be in every move. You don't need to be the first one in. You don't need to be the last one out. Guys, what we're doing is we are taking chunks away from the decision-making points, using momentum, and we're learning how to get paid consistently. That's the goal of trading. This is a business, and we're not going to give our money away. So, is everybody on board with me so far? Momentum is always momentum. Strong triggers are always strong triggers. And strong triggers are amazing, but we have to pair them and make sure that we're not trading into areas that could stop the market. And we see these long before we ever get to them. But once we have these rules met, once I have the advantage of momentum, once I have a clear path or even the potential to break, I'm going to look for an entry, guys. And this is where the precision, this is where the magic happens. Your entry rules are very precise. They're so precise that you're going to wait for the market with a limit order, which means that you're going to wait for the market to come to you rather than chasing the market. You're going to use that limit order to buy or sell a pullback. And if you remember, a pullback is that little retracement that the small crowd creates. It's that 7, 8, 9, 10, 15 down bars on a small chart when your large chart is screaming to the upside with nothing in the way. It's the fight. We're going to pinpoint where that fight is most likely to lose for the small crowd. And it's at areas. We're going to use Fibonacci support or resistance. We're going to use mid bands, and we're going to use yellow 1-to-1s. And here's the deal, guys. You want those areas inside of triggers. Your trigger lines are moving averages, and there's this gospel truth that price tends to return to triggers. So I want you to see this. Price accelerates away, and it snaps back to triggers. And it accelerates away, and it tries to get back to those triggers. And it accelerates away, and it pulls back to those large triggers, guys. Large triggers are like a magnet for price, and it happens over and over and over. So when we talk about the precision of entry, we want our areas to be inside of triggers. Those large triggers define where the market is most likely to reverse. So when it starts that fight, that push, the market may return to my 5-1 large triggers. It may return to my 13-2 large triggers. So my brother, in his infinite wisdom, has put the 13-2 large triggers onto your entry chart. And this is defining where the market may return, where those price bars might come back. So rule number 3 says you're going to buy or sell a pullback at an area inside of triggers, because triggers is where the market's most likely to retrace. Favorable large triggers increase your advantage. Favorable large triggers means that your large triggers and your synthetic triggers, the large triggers from both time frames, are one on top of the other. I want you to picture 2 snakes riding piggyback, because when they're tight one on top of each other, you've got a much smaller range where the price bars are likely to return. And then when you put areas inside of there, fibs, mid bands, yellow 1-to-1s, you have a very precise location where the small crowd is likely to fail and where the trend is likely to bounce and continue. So when we're defining entry areas, we're using fibs, mid bands, yellow 1-to-1s. These are what create the bounce. They're like a brick wall and price is a tennis ball. And we can use these to create a very precise entry. So the more stacked the triggers are, the smaller the window becomes. The more space between those trigger lines, the bigger your window gets, the higher your risk gets, the little bit of indecision. So when we're talking about rule number 3, we're going to buy or sell a pullback at an area, and initially let it be inside of those favorable large triggers. And this is on the 5-1. Thank you, Blue Pearl. Your entry comes from the 5-1. My buddy Marty sent me a message yesterday. He says, you got to remind people that the entry is the small chart, the 5-1 chart, because new people don't remember that. Thank you for saying that. Your entries come from the small chart. Your entries are using a refinement process. And let me show you a cool picture. Inside of 1 bar on the large chart, when the momentum is strong, when the path is clear, the potential's there to break, and the trend is down, all of this information is inside of that 1 bar. You have a full pullback, you have a bounce in an area, and you have continuation with the trend. And all of that happens inside of this 1 bar from the large chart. That's why we use the refinement chart, because it's going to allow us to reduce risk. So you missed everything, Rob. You might as well just go back to bed. Kidding. So when my large chart says up, right? My trend is up. When my large chart has odds favorable momentum, when my large chart is not trading into a termination condition, Blue Pearl, that's when we turn our attention to the smaller, faster chart. So I don't know what's happening right now. This is my large chart. And let me pull up my small chart. And guys, they're different charts. They'll have different mid bands. They'll have different 1-to-1s. They'll have different divergences. But I want you to see inside of this 1 bar on the large chart, There was a pullback to an area inside of triggers. Pretty cool, right? So how do we define where our entry goes? When the large chart says look for an entry, the first thing to do is wait for a reversal bar. Wait for the fight to start. And you will have the fear of missing out, and you'll be terrified that the market's going without you, and you might even try to jump in and just hope that momentum carries you. Guys, if you jump in when everything is going up, that's fine. Take your trade. If you get a reversal bar and the close of that reversal bar, it finishes printing on the other side of the triggers, you got to get out of that. The momentum has slowed. This reversal bar signals the beginning of the pullback. It signals the beginning of the fight. It lets you know that, hey, we may get that retracement to the large triggers. So once the reversal bar prints, not your entry, you're going to define your trigger lines from the highest point to the lowest point. These trigger lines let you know where these price bars are most likely to return. Once you find your trigger lines, you remind yourself, my entry doesn't come from triggers. I need areas inside of those triggers. You're looking for fibs, mid-bands, and yellow one-to-ones. And in this case, we have a mid-band up top that is closest to the reversal bar. We have yellow one-to-ones inside of those triggers. These are furthest from the reversal bar. But both of these might be the spot that produces the bounce. So you're going to create the window of opportunity, guys. The window of opportunity will extend from the highest level of support to the lowest level of support. It doesn't matter if it's a mid-band. It doesn't matter if it's a one-to-one. It doesn't matter if it's a fib. If it's inside of those triggers, it's one of the spots that could create a bounce. Any lines, any fibs, any mid-bands, any yellow one-to-ones on what I call the wrong side of the triggers, below the trigger lines, beyond the retracement point. Guys, these aren't part of the equation. These are not in the window, and to be honest with you, this is where the market should not go if it's going to be one of those 70 to 80%. This is where the market should not go. This is where your edge is no longer in place. Your advantages are no longer there with rule number 3. This is actually where your initial stop will be placed. And again, we can do it to the upside or the downside. So if you flip the image that we just looked at, everything is going down, it's red, there is strength, there's momentum, there's nothing in the way. I'm going to wait for the reversal bar. And at the time of the reversal bar, I'm going to say the fight is on, this is not my entry, but where are those trigger lines? Where is this market most likely to retrace? Where is the small crowd most likely to push it? And that's from the lowest point of the triggers to the highest point of the triggers. That is the zone, but I need areas. I need fibs, mid-bands, or yellow one-to-ones inside of those triggers. And look at this. There's one mid-band. That's it. Just a mid-band inside of those triggers. Guys, that mid-band represents the point where the market is most likely to continue, where it's most likely to bounce and continue with that trend, where the small crowd is most likely to fail and the large crowd takes back over. Your job, because of the momentum and the clear path on the large chart, is to activate a limit order a couple ticks below that resistance, to activate a limit order a couple ticks above that highest point of support. And this becomes your entry for the highest probability trend trade. This is where you've identified where the market is most likely to continue, which means you understand that any lines beyond those triggers, on the wrong side of the triggers, are where the market should not go. And this is where your initial stop will be placed. Guys, the pattern is consistent. The easiest way to learn it is to go back and study it, is to go back and see this, to be able to recognize momentum. Is everybody good with momentum? Smalls above the large, larger wide, space between. Can you give me a Y if you see that rule number 1 is met? Awesome. The second rule is making sure that you have a clear path or at least the potential to break. And look at this, the small triggers have absolutely smashed. The large triggers are almost through, but not quite. That potential is there, guys. The market is trading, at, if this were a live market, right where my laser pointer is. This is where I make the decision. I need that, actually probably closer to here. I need that reversal bar. There's my reversal bar. There's my pullback, and it hits support inside of triggers. It doesn't go beyond the triggers. If you circle these tails on the large chart, after the fact, historical study, and it lines up with support, resistance inside of favorable large triggers, guys, this is your pattern. This is your trade. And what you'll find is that it's easier to study. There's the tail with the potential to break, and it came back 2 ticks above Fibonacci support. A lot of you would have gotten this trade, would have taken this long trade and ridden that momentum up. Let's see if we can find another. I need odds favorable. Market's going a little crazy with the day of mourning. A lot of consolidation there. Here we go. 6:27 a.m. I'm going to circle that tail. And once again, do you guys see? That is all the momentum, and I haven't reached my areas. This is the perfect look. Let's go back and find it on a small chart and see what it looks like. Didn't quite make my mid-band here. I might not have caught this trade, but do you guys see the pattern? Momentum, path, pullback, and those sons of guns just didn't get me. They tried to, but the momentum was so strong, probably not a trade there. So let's back it up and let's see what this one did. All that momentum, haven't reached the fib, potential to break this area. And there it is, right to the mid-band, sitting right on top of those triggers. Guys, this is your pattern. You're going to right-click, and that limit order is sitting right there, 2 ticks above it. Are there any questions about the high probability trend trade? Guys, it's only 3 rules, and if you're brand new, those 3 rules feel like an awful lot. Let me show you how to make it easier. Taking pictures, guys. I am such a firm believer in the power of pictures and annotation. I want you to see my library. I am at, in 2025, I'm up to 160 pictures. This is the 9th day of 2025. I'm already 160 pictures deep, and 2024 was over 7,800. I take a lot of pictures when I study because pictures slow the market down. Annotating it makes these looks easy. So in order to get to where you want to be, you've got to be able to recognize these looks and patterns quickly, guys. And that comes through repetition. Repetition creates that recognition. Repetition will slow the market down for you. It's amazing how that works. So the easiest way to get to where you want to be is I want you guys to do this. You don't have to do it in a day. Take 3 pictures each day, but 25 pictures of strong triggers, 25 pictures of weak triggers, 25 pictures of that clear path of terminations and entries, guys. And then go to your spreadsheet and fill this thing out. And I've already given you an unbelievable start here. But if you go through the process of taking a picture of strong triggers, if you say they are strong because my smalls are above the large, they're wide in the direction, this is strong triggers, rule 1 met, look for longs on a smaller chart. Guys, you're never going to trade without the advantage of momentum unless you make the choice to trade without the advantage of momentum. You're never going to trade into a termination condition unless you make the choice. It's not going to happen by accident. This is the quickest way to get to where you want to be, but it's not just the pictures, it's the writing on the chart, it's the annotation. It's creating that connection between what you see and what it means to you. Do 5 a day and tell me it didn't help. Do 10 a day, tell me it didn't help. Finish this exercise and try to tell me that you're not a better chart reader. And remember, chart reading is what opens doors. So while you're doing that, we're all new, right? Mark, I don't even know what this stuff looks like. Here's the high probability trend trade checklist, guys. Is the market coming from a strong top or bottom? Why do we ask that? Because it sets you up for the highest probability trend trade ever. But it's not mandatory. There's only 3 rules, and a strong top or bottom is not one of those rules. But when I have a no triggers through termination that reverses that market, guys, I can't wait to take that high probability trend trade because I know that it gives it a little extra giddy up. Do I have momentum? This is your checklist. This is what momentum looks like in an uptrend. This is exactly what it looks like in a downtrend. And this defines weakness very clearly. You should be committing to the best of the best. When you're taking your pictures of strong triggers, they need to look like this. Here's that life cycle. Price reaches resistance, no triggers through, not a clear path. Sit on your hands, be patient, wait. The market moves all day long. Small triggers smash, large haven't made it. I've got the potential to break with that odds favorable momentum, but my path isn't clear until the small and large are through, guys. These are your pictures. And then here's your entries, whether it's a long trade or a short trade. This is what you wait for to start the pullback, looking for the triggers, identifying the areas, and exactly where your limit order goes if you're going to follow this plan. I've given you everything that you need to study here. It's shut down 8:30 a.m., Rob, day and morning. So you've got to have a plan. I met a Nexgen user once. We were out at the motorcycle races here in Austin. And he's been a client for, goodness, 17, 18 years. And he told me, he said, Mark, I spun my wheels in the beginning. I tried to be smarter than the software. He goes, and I tried to wing it. He goes, until I had a written plan, until I had a plan to follow, I struggled. So guys, I give you a plan on day one. And I teach you how to use it. This is the KISS plan. This is my gift to you. And the KISS plan is a stepping stone in your learning journey, guys. The high probability trend trade is not the only trade. But the high probability trend trade is the trade that teaches you to read your indicators, that teaches you to recognize those next trades. And this plan is designed to optimize your chances of success because success creates confidence. We're building trust in the methodology. We're learning how to read the software. And then it will be through simulation, study, class feedback, and continuous practice. You'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, I'm sick of AI. That's what that is. You'll build your plan based on your ability to read your charts. There we go. I like that one. That's it. So Kurt, today is the day of mourning for Jimmy Carter and equities are closed. I believe crude oil and gold are still moving, but NASDAQ and everything is shut down for the day out of respect. Guys, once you can read indicators, you're going to find your trades. You're going to build your plan. You're going to get to where you want to be. And you don't have to do it alone. As you develop your plan, oh my gosh, drop your pictures in here, guys. Let's build a plan together. Let's focus on these things together. But your simple plan for consistency, big red bold letters underlined. Don't fight the large chart. This is my brother's best-selling book, How to Commit Financial Suicide in One Easy Step by John Novak. Chapter 1, warning signs your friends are in trouble. They are trading against strong triggers, believing that they can beat the big crowd. Chapter 2, warning signs your friends are not paying attention. They trade into termination conditions. They trade into those lines that we've proven can stop the market to end the forward progress. Seek help immediately. And I like that part of it because, guys, I'm the help. I didn't realize that I was trading into termination conditions and that's where all my money was going until I posted in the education room before I ran it. And I got that feedback, and my brother recognized patterns in me. Mark, you're fighting triggers, hoping that fib holds. Mark, you're trading against the trend. Mark, you're trading into these lines. Here's how you fix it. And that's exactly what we'll do with you guys. But you got to post in there. And you've got to define your entry. Have you guys noticed that all we've talked about is how to get into the market? How to identify a strong top or bottom. In this plan, you're going to get pictures of strong tops and bottoms. How to identify momentum and not go to that next rule until we have it. And then how to define a termination and where to look for your entry. Guys, all we've done is defined how to get into the market, how to take that best of the best trade. Because great trades create very manageable trades. And that's the second half of trading, is managing. Getting in to the highest probability scenario is the first part, and it opens the door for management. And your management plan in this KISS plan is designed to get you paid, and it's designed to teach you how to move your stops. But more than anything, it's designed to have you developing trust in the large chart, getting to the point to where you believe that with all of this momentum and nothing in the way, I can get paid with this best of the best entry. So your management plan in the KISS plan is predicated. It's dependent on your ability to find the entry, right? That's why we talk about entries all morning, every morning. I need to get into the market where the market is most likely to continue, because by defining this area, I know exactly where my first stop should go. My initial stop will be placed 4 to 5 ticks below those trigger lines where the market should not go. And at this point, there's nothing for me to do. I'm either going to get stopped out or I'll get a reversal bar. And I want you to write this down, especially you guys that are new to trading. You will take losers. Anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. That's why we develop trust in the methodology, because we don't want to miss them. We don't want to let our guts keep us out of this perfect trade because we had a feeling or a notion. We want to take it every time the rules are met, because that's what makes the sample work. So I'm either going to get stopped out or I'm going to get a reversal bar in the direction of the trade. It depends on the market, Blue Pearl. I would say that on any typical day, I would say 2 to 5, absolutely perfect textbook, can't find anything wrong with it. Doesn't feel like a lot of trades, right? But once you throw in those medium probability trades, Blue Pearl, once you follow the plan and you begin to take trades where the market has the potential to break an area, I don't think it's uncommon, and you more experienced users, 7 to 10 trades a day, potentially. Maybe you take a hickey on 2 or 3 of them. And Blue Pearl, my entire plan is trend trades, and I only trade one market, but I trade the NASDAQ, so there's a few more opportunities. But this is why I spend so much time every day reminding you guys that 90% of your day is doing nothing. Most people are hitting their goals before lunch and going and playing golf. Guys, when I get in where the market is most likely to continue, my initial stop is where it shouldn't go. If I get a reversal bar letting me know that the market is going in the direction of the trend, the market's going towards that clear path, towards my targets, I'll reduce my risk 2 ticks below. And at this point, there's nothing for me to do. I'll either get stopped out for a smaller loss, and I'm going to tell you guys, there will be times where you'll get in perfect. You'll move that stop. You'll have like 2 ticks of risk, and they come and get you. It's a part of it, guys. It's a part of it. But this is it. I'm either going to take a small loss or it's going to go to my first target. The KISS plan is designed to get you guys accustomed to getting paid, to realize that everything doesn't have to be a home run. So your first target in the KISS plan is $100 away from your entry. That's it. It's 8 ticks on the S&P. It's only 10 ticks on crude oil. And if it hits that first target, that $100 goes into your account. If it hits that first target, your sweaty palms dry up, your adrenaline starts to lower, and your heartbeat goes down. And that first goal, guys, is what really creates the confidence. You've just made $100, and you're going to move your stop to break even. Why? Does break even make sense? Maybe not. Maybe break even isn't the best stop, but you know what? You will make your own plan with a little bit of experience. What this does, what break even does for you, is it reminds you that you would never be in this trade if it weren't for odds favorable momentum and a clear path. And this gives you the courage to hold on for your second target. And the second target in the KISS plan is only $200 away from your entry. That's it, $200 away, which means that in one trade, all the advantages, very, very conservative profit targets, that's a $300 trade. And a $300 trade, if that's the best you do in the 252 trading days in a year, is a $75,000 year. Let that sink in. One crappy little $300 trade a day is $75,000. Guys, throw in a break even, you're in 6 figures. Double your contracts. You're 6 figures twice. The idea isn't to catch every move. The idea isn't to catch each fib and get in and to be the first one in or the last one out. The idea is to get paid consistently each and every day, giving yourself the highest chance of success every time you pull the triggers. So when you're done practicing, when you think you have it, when it's time to go live, there's two things that you have to know. You have to know why you will enter a trade. And it has to be rules. And your rules need to be proven to win more than they lose. And Nexgen's already given you your first trade. And honestly, when I give you this KISS plan, I've also given you your second trade, the potential to break trade. And I've given you rules that will optimize your chances of success. But this one is dependent on you understanding the lessons that you got from this one. You also have to know why you will exit. And can we all agree that management is where we tend to fall short? The entries aren't difficult. But management, you've got to fight a little emotion in the beginning, which is why it's so pragmatic in the KISS plan. Because management is an understanding that my advantage is gone. And my targets haven't been reached. So, for example, if I get into the market where the market is most likely to continue, my advantage is gone 4 to 5 ticks below those triggers. That's my exit. If everything is going up and I get 3 divergences in the same price range, that's a termination condition you'll learn about as you grow with the software. I need to exit. But in the beginning, I don't want to think about all that stuff. So I just want to follow the KISS plan and keep it real mechanical until I start to recognize these patterns. And then here's your little red flag. Every trade that you add to your plan has different rules for entry and different rules for management. So I encourage you guys, get really good at one thing. And then once this becomes second nature and doesn't take a lot of thought, that's when you add the next trade. Rules, this is a quote from Mark Douglas, the late Mark Douglas. Rules eliminate the need to know what's going to happen next, guys. Rules put you in a position where you don't care what happens next because you know that you're trading a pattern and that pattern has been proven to win more than it loses. And day trading is not about the one trade. Day trading is about a sample, 20 or 30 trades. I'm going to give you all of these. Pardis, welcome to the room, by the way. I'm going to give you guys all of this stuff because the one thing that I promised you when we started was that I would give you everything you need to be successful with the software. So what we've done, wow, it's not going there. So what we've done so far today, where's my picture? That's not it. Sorry guys, I confuse sometimes. Is we've talked about the rules. So if you're brand new with me, we talk about the rules every day. We talk about the same thing every day. We talk about momentum, how to identify it, how to study it, what it means to you. We talk about termination conditions, how to identify them, how to study them, what they mean to you. We talk about entries, exactly where to get in, stop placement, everything. You guys have the ability to simulate, and you have the ability to ask questions live 15 hours every week, to post pictures in the room and get your questions answered. Guys, I'm telling you, and it's not because I'm the head of the education here. I think the education is what sets us apart, guys. There's no reason for anyone to ever be confused as long as you're willing to use your voice. I've given you the trade plan, everything that you need, how to enter, how to exit, all that good stuff. So what I'm going to give you guys right now is, and this is a zip file. And if you need help downloading it, let me know. You just extract it to a folder. But I do know not everybody wants to download a big file like this. There are the PDF versions as well if you're uncomfortable downloading the zip file. So what you guys have now is you have the 101 chart reading, how to identify each rule individually, how to annotate that chart, how to get really good at chart reading. You have the high probability trend trade checklists, and then that is the one that not only shows you what it looks like to have the rules met, but also gives you a printable checklist for your desktop as you go through and study. You guys now have the KISS plan. How to enter the market for the highest probability trend trade, a very mechanical way to manage it as a brand new user, and it includes the 50-50 trade. And the 50-50 trade is when you don't quite have that clear path, when the large triggers haven't quite made it through. And guys, in this 50-50 plan, it's just like the high probability trend trade. This is designed to optimize your chances of success. So it talks about a strong top or bottom, and it assures that you have momentum on both charts because we've already given up that clear path. And it says don't take it if there's divergence, because divergence is a loss of momentum. And it reminds you, don't take it if there's divergence. And then when you get to management, it's a little different, and it tells you the third time. Divergence is the biggest killer of these 50-50 trades, guys. So this is going to open the door for the next trade, and then that's going to open the door for more trades. This also includes your daily goals, reminding you that base hits pay bills. You knew, guys. Has everybody seen Moneyball? And the whole premise is he gets on base, right? Getting on base, you only have to do it 4 times to hit a home run, right? There's your home run, 6 figures. Take 4 break-even trades a day. After the first target, you're still in 6 figures. It doesn't have to be a grand slam to get you paid. And then also included in there is the exit conditions, guys, reminding that you need to know why. And if you're not sure, you need to ask for help. That's what I'm here for. This is, for those of you that are new, Steven and who else is new? Blue Pearl. Did you notice that I said the same darn thing that I said yesterday this morning? That I didn't change the rules, that I didn't change the looks, that I didn't change how to study it. This is the repetition part of what we do. This is making sure that you guys are comfortable with these very basic concepts. And this is my favorite part. This is how I end my first hour. This is how I stop before we go to chart reading every day. The key to all of this is having a foundation, guys. I want you to think of yourself as you're a freshman in college. And when I was a freshman in college, I had to write the boring papers, and I had to take the remedial math, and I had to learn the basic history, the same damn thing that I learned in high school. But what it was doing is it was building that foundation for me, and it was giving me the skill set that I need, and it was teaching me how to study, and it was teaching me how to get my stuff in on time. And that opened the door for more and more and more advanced stuff. And when I got into my more advanced classes, my junior years, my senior years, that's when I got to read the books I wanted to read. And that's when I got to write the papers that I wanted to write. So you guys, I'm giving you that foundation. We're understanding the basics. And I want you to compound just a little bit each and every day. I want you to embrace this philosophy, Kaizen. Continuous improvement. Become 1% better every day. Don't put the pressure on yourself to be great in the beginning of your journey. So for you new users, I will blanket you with very conservative rules. We're going to talk heavily about the recognition of advantages. I want you to speak out loud at your screen whether or not you have these advantages in play. I'm giving you a very solid plan that optimizes your chances of success as a new user while you're learning to read your indicators. And I'm giving you live help to make sure that you're reading them correctly. So for you new users, it feels like all termination conditions are bad and no momentum is horrible, and not entering at the areas inside of triggers is the worst thing you could ever do. But the reality is that I give you these blanket rules because they increase the likelihood of success. They're not always bad, but until you have the experience to know when to use the exceptions, it's safer. And you guys that keep it simple, and I'm going to say this right now because I'm kind of proud of this. I've had people get funded in those prop firms in their first 30 days with Nexgen by taking that super simple approach to learning the very, very basics and keeping it mechanical and just giving themselves these advantages. So like anything else, the more time you spend with this, the more you're going to see, the more patterns you'll recognize, the more trade opportunities that you'll have. And this opens the doors for you. But you've got to learn the process that yields the results, guys. The results come from taking the right trades. The results come from intelligent management. The results don't come from your desire to get rich. You've got to learn the process. And your goal has got to be flawless execution of the process. The results follow. And this is where the KISS plan comes in. If you keep it that basic, if you follow simple rules, And if you're okay not trying to do what everybody else is doing, if you're okay not trying to take all the trades that everyone else has taken, because they're ahead of you, guys, you can find an extraordinary level of success. I've seen it for years. And the further you deviate from simple in the beginning, the longer it's going to take you to get comfortable with pattern recognitions, because you're creating too many variables, right? The KISS plan is your control in this experiment. So question everything. Every question you have, it needs to show up in this room, guys. You should never wonder what the answer is. You should force me to give it to you. I want you to learn. And I also want you to give yourself a little bit of grace, because you are new. And it's not fair to put the pressure on yourself to be a successful day trader in 5 days. I'd love to, Blue Pearl. And it's okay to be new. So let's explain the triggers on the 5-1. And here's the cool thing. And you're going to love this. Let me save that. Let's get rid of some stuff. And let's go to some trigger lines. And you know what? I took a picture today. Go to my editor. So here's the cool thing. Blue Pearl. Whoops, let me do this. You don't know if this is a large chart or a small chart. So let's go through what triggers are first. Small triggers are always small triggers. They are a fast-moving average. Doesn't matter what chart you're on. And then large triggers. Here, let me do this. Let me just do small triggers. Are a fast-moving average. They are the same no matter what time frame. There we go. A little more clarity there. Struggling with my Snagit. I'll just draw a new one. Why I take breaks? Steven, I take breaks because I don't want to sit in a chair for 3 hours straight. I hydrate, I have to pee, my dog needs to be pet. Sitting in front of a computer nonstop is horrible. Nobody's good after 3 hours of staring at a screen. I love it. My wife has one of those desks that you stand at. So large triggers are the slow-moving average. And I'm not going to lie to you, Blue Pearl. I don't care if they're fast or slow. It doesn't matter to me one bit. And large triggers are the same on any time frame. So every time frame has large and small. And we're going to do this. We use the large and small triggers together to define momentum. So this is universal for every chart. Let me give you this picture, because I am going to build a little something here. So I'm gonna save this real quick as well. And then we're gonna go to the 5-1. And what I'm gonna do with this one is I'm gonna get rid of every indicator. You didn't realize that you were going to help me build a trading manual, did you, Blue Pearl? I'm going to leave nothing but the trigger lines on my large chart because triggers are universal. And then on my small chart, I'm going to get rid of everything but trigger lines, because I want you to see the two charts together, and I think that will help. So let me apply that and be okay. This should be a pretty good picture. And I'm going to put a box around the large triggers on the large chart. Oops. And I'm going to put a circle around the large triggers on the small chart. And we're going to take a picture and we're going to talk about the triggers on the 5-1, because remember, And this is I'm going to give you guys the whys. I think the whys are so important. And I'm going to do it up top. So, price typically returns to large triggers no matter what time frame. It happens on the 13.2, it happens on the 5.1, it can happen on a range chart, a tick chart, a month chart. So this is the first thing, is price typically returns to the large triggers. We have two time frames, which means we have two different large triggers. Are you with me so far, Blue Pearl, everybody in the room? Since the small chart is an entry chart, is my entry chart, I want to see the large triggers from both time frames so I understand where the market is most likely to return. And we're going to run out of room on this one. So what we have, Stephen, and let's back up a second. Are you comfortable with the idea of small triggers and large triggers? Every chart has them. Okay, cool. So this is a large chart. It has large triggers. And the expectation on that large chart, Stephen, is that price tends to return. And you can see it right here. Price pulled back. Come on, shape. Uh-oh, I think I'm about to kill my snag it. Here we go. Price pulled back to the large triggers here. Price pulled back to the large triggers here. It even, when it broke away, it snapped back right here. So do you see how price tends to pull back to the large triggers? It happens on the small chart too. Price tends to pull back to those small triggers when it breaks away. And let's go back to the language of the entry. And I think this will help you. So our entries say that we're going to buy or sell that pullback. We're going to buy or sell. We're going to buy or sell that fight from the small crowd, which means that we need a retracement. Which line? Sorry, which line, Stephen? I want to make sure I get all your questions answered. Oh, the line I pointed out. Uh-oh. Hold on. Okay, to the large trigger. This line. From the small trigger to the large trigger. Okay, this is just showing you what I'm talking about. So this arrow says, hey, Stephen, check it out. I'm pointing to the large triggers. This arrow says, hey, Stephen, check it out. I'm pointing to the small triggers. And I have it anchored on the description there. That's kind of what that is. So small triggers, fast moving average. Large triggers, slow moving average. And then we get back to, oh, can you take a picture of my screen and show me? Because then I don't have to guess. The dark line. Is it on this picture? Is it this line? Oh, hold on. You're talking about this line right here, yes? Awesome. So when we talk about, yep, thanks, Nanda. So when we talk about entries, I'm so glad you did this. Check this out. You'll love this. So inside of this one bar, Stephen, is all of these bars. Does that make sense? This is a big slow time frame. This is a much faster refinement time frame. Okay. Check it out. I love this. All right, Steven, I'm going to draw a box around 1 bar on my large slow chart. Oh no, get over there. I'm going to draw a new box because that one didn't go where I wanted it to. There we go. So see how this one bar, and it has that tail or wick on it. There we go. See how it has that tail or wick? That happens. Watch this. I'm going to draw an arrow on the small chart from the reversal bar to the bottom of the triggers. Do you see how all of these bars are still inside of that 1 bar? So this chart says odds favorable momentum. This chart says clear path. But I don't know where this tail might happen. I know that it may pull back to the triggers. And more than likely, it's going to pull back to areas inside of triggers. So I don't have to wait for this tail to form to take a trade. What I can do, Stephen, and what you can do, is you can identify fibs, midbands, and yellow 1-to-1s inside of those triggers. And that's where the tail is most likely to form. You should have it up in front of you all day long. Let me put the indicators back on it. This is futures. This is my workspace. Whoops. So you should be looking at right now on your screen. No, we're not predicting the future. Let's see if we can find one live. All right, here, let's do this. Dun, 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 dun. 4 a.m., 4 a.m. I'm trying to find the one. You'll know your pattern ahead of time. You'll know what you're looking for. So here we go. All right. So this is what it's going to look like live. You're going to have momentum. You're going to have the potential to break this area. Does that make sense? And your small chart's going to look like this. The top of this move is very much the top of this move. So this is where, Stephen, your brain is going to say, okay, I have the reasons that I need to look for a trade. That's what I want you to get. It's going to look like this. You won't have a pullback. There won't be a tail. But you'll say to yourself, these are the patterns that I'm looking for that tell me it's time to look for a trade. Does that make sense, everybody? And I can't tell you how much I appreciate the questions. So, Stephen, this is where I go through my rules for entry. So I'm going to do this. Once this says look for a trade, I don't need this chart anymore. I'm not worried about tails or anything. So once the rules are met on the large chart, I will turn my attention, Steve, okay, to the small chart to find my entry. First thing I need is a reversal bar. This is the visual that my pullback is starting. And I'm making all these pictures for me as well. So I'm going to drop that one in there. So I need a reversal bar. So with this look, it's never going to change. Market goes up, there's my reversal bar. And I'll make this a little bigger because we're going to do some awesome study pictures here. So once I get the reversal bar, I will identify where this retracement is most likely to return. Or well, I'll just put go. Price tends to return to large triggers. You can. I want you to save everything, Steve. I want you to look at these things 1,000 times until they're second nature. I have large triggers and synthetic triggers on my entry chart. So from the highest line of the triggers to the lowest line of the triggers is where the market is most likely to retrace. And more importantly, Steve, do exactly what you're doing. Keep asking questions, because for every person that asks these questions, there's 10 people that are afraid to ask them. So once I get the reversal bar, I draw a box from the highest point of the trigger lines to the lowest point of the trigger lines. And this is where the market is most likely to retrace. This defines where this pullback is most likely to go. Does that make sense? From the highest point to the lowest point. So it's a little bit of a range. So far, so good, everybody? I'm going to give you guys this picture. It's a great way to start, New York City Pug, because I want to know where that retracement might go, right? Let's take another picture. You know to anticipate it, Steve, because you have momentum and the potential for an area to break, because you have rules 1 and 2 met. Because I have the rules met, once the rules are met on the large chart, that's when I go to my small chart. That's when I wait for the reversal bar. So my anticipation starts before the reversal bar ever prints. I'm just chomping at the bit. I can't wait to get into a trade. Once the reversal bar prints, I start looking for my trigger lines. And I'm going to be honest with you, Steve, with a little bit of study, you're gonna start looking at trigger lines before. No, not at all. Watch this. We'll go through the timestamps. So there's the reversal bar, and you're absolutely right, Blue Pearl. I'm not worried about the small triggers. I use those up against the large triggers to define momentum. But price tends to return to the large triggers. It's that slower moving average. So I don't have a trade yet, Steve. I've gotten my reversal bar. I've found my triggers. And then let's type it out. When I identify my trigger lines, I understand where the market may return. I need an area. This is an uptrend, so we would be buying. We would be buying because the large chart is green, because the trend is up, because the momentum is up, and because the path is clear to the upside. So we're going to look for a long trade. So I need an area inside of triggers. Areas can be fibs, since we're up, blue fibs. It can be a mid band, It'll be green for long trades, or it can be yellow 1-to-1s. These are the areas that I'm looking for, but they need to be inside of triggers. So check this out. This box that we had on the triggers, and I'm going to do it like this. These were our triggers, right? That's where the market may retrace. But look at this. The areas inside of triggers make that box much smaller. In this box, from the highest area inside of triggers to the lowest area inside of triggers shows me where the market is most likely to bounce in the direction of the trend from the large chart with the momentum from the large chart and in the direction of my clear path. So all we're doing So the charts help you know when to know the best place to buy by seeing the mid-band and the upward trend, the space between the large and small triggers lines strongly separated. So, kind of, momentum tells me to look for termination conditions. No termination conditions, that's when it tells me to look for an entry. So the large chart is done. So when I look for the entry, I wait for the fight, and I define where the market is most likely to return. And then I define where it's most likely to bounce. And then we're not done yet. So check this out. Once I do that, I'm going to right click. Well, it's a combination. Once I create my window, my box, so let's put this back on there. Think of a flow chart, Stephen. So when I have momentum, bump, 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 I look for terminations. If no terminations, bump, 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 I go to my entry chart and wait for a reversal bar. When the reversal bar prints, bump, 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 I identify my triggers, and then I find the areas inside. This is my potential entry area. My job is to activate a limit order 2 ticks above the highest point of support. If price returns to that area or to my order, I'll be in a long position. So it's really a flow chart. You're starting with momentum. And then from momentum, you're going to make sure there's nothing in the way. And when there's nothing in the way, you'll adjust your charts and you'll wait for this. And you'll find the triggers. And here, let's do this. There's your triggers. There's your areas. And this is where your order comes in. And then let's timestamp this. So my reversal bar was at 10 minutes after the hour. And this is the middle of the night, but that was a half an hour to get to my entry. But of course it was in the middle of the night. Very often you'll have anywhere from a minute to 5 minutes. And this is what it looks like. Do I have momentum? Yes. Clear path. Potential to break. Not broken yet. But if my rules are met, I can take a trade based on that potential. Entry comes from highest support inside of triggers. Stop goes 4 to 5 ticks below lowest trigger line. And this is what it's going to be. You're going to come back and you're going to see that. And then let's see what happened. So I'm going to give it a bar. And there's that reversal bar. Right off the area, right inside of those triggers. And Stephen, look at this. I'm going to put a circle around the bottom of that bar. I'm going to fast forward one on the large chart. There's your tail, brother. We didn't need that tail. We had a pull back to support inside of favorable large triggers. And what you're going to find is that you are anticipating where that tail is most likely to happen through the rules of the high probability trend trade. Does that make sense? Maybe. You remember, you're day 2. That's okay. It was a new look for me too. And now I'm teaching the class. So you can predict where that tail is likely to bottom out by using support inside of triggers and anticipating its move there. And you will literally buy the market while the market is coming down on that small chart. But do you notice how nothing changed on the large chart? The large chart still has momentum. The large chart still has the potential to break. Like everything good about those advantages is still in play on the large chart. And we use that refinement on the small chart so that we can pinpoint. So this is why I talk a lot. Let's learn to break it down individually. Let's learn to wait for advantages one by one and really have that flow chart. So it always starts on the most current bar. Do I have momentum? Do I have odds favorable momentum? What do you guys think? One trigger is green, the other is red. I've talked about it, Stephen. I just don't think I said it so that it clicked. So again, I'm super appreciative of your question. When you guys ask questions, it puts me in a position where I have to answer so that it makes sense to you. Yeah, no worries. But this is how it works. And when you guys ask, I realize that there's a hole in my teaching. I realize that I'm not saying something so that it clicks for everybody. So I'm incredibly thankful. So check it out. Stephen, do you see the momentum? And I'm going to take everything off of this chart real quick, except triggers. Remove, 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 apply, okay. So let's pretend like there's nothing on the large chart. There we go. Do you see the momentum? Small's below the large, large are opening up, scissors are open. Everybody good with that? That's rule number 1. If I have strong triggers, I have to make sure that I didn't hit a line. And guys, I didn't hit a line, did I? I haven't hit a fib, I haven't hit 1-to-1s, I haven't hit a divergence low on my large chart. I have momentum and a clear path. What do you mean? What creates? Buyers and sellers pushing the market. Creates all the movement. These are just moving averages. These price bars are sellers pushing the market down. That's it. So check it out. I have momentum. I have a clear path. Steven, I'm waiting for a reversal bar. If I get it, there's the lowest point of the triggers. There's the highest point of the triggers. These 1-to-1s, whoop, that one was pretty quick. I'm in at the area, inside of triggers. And my stops have to go above the triggers. And it might bounce from these 1-to-1s. It might bounce from this mid band. It might just crater and come and get me. And remember, I took all my large chart areas off, so I'm not sure if I truly have a clear path. But that's exactly what it looks like. Absolutely. And you know what? Let me do a better picture. Let me just grab an established picture. So when we talk about the window of opportunity, for a long trade, for a long trade, it will extend from the highest point of support to the lowest point of support inside of favorable large triggers. And that's the key, inside of the triggers. So sometimes you might have 3 lines right on top of each other. There will be times where there's a little more space between the two. There will be times where it's just one line, but your window of opportunity is always the areas inside, and if there's any space between those areas, that's what creates the window. Here we had one line inside of triggers, and it bounced right off of it, and then that trade actually failed. But the risk would have been virtually nothing behind it. There's that same picture. And this is what it looks like together. The large chart never blinks. The large chart never changes. Well, there's only one synthetic trigger, Nanda. And synthetic is how Nexgen says from a different time frame. So this large trigger is the synthetic trigger. So if price can return to the triggers, it could return to the large or the synthetic. That's why we use both of them. All the wick is, Steve, is that pullback. You don't see it on a large, slow chart. This chart is so stinking slow. See how it's still odds favorable? See how it's still? That wick is this pullback right here. Watch when I stop this at the top. It's right at the top of the wick. That wick is this pullback. But because this is such a slow moving chart, you don't see any pullback. You just see one bar. There's your pullback right to resistance, right at the triggers. And watch this. You won't get another bar on this chart until price pushes all the way down here. But look on your small chart. 1, 2, 3, 4, 5. We're already 6, 7 bars deep into the pushback down. This is how the refinement process helps you minimize risk. This is how the refinement process helps you maximize profit potential. Because this wick is only a wick if I get a down bar. If the market continues up, I'm gonna get a big up bar off of it. This wick only happened because of the down bar. This wick only happened because of this pullback. And we'll see. If it prints lower, if it goes down to that yellow line, that's when it'll print it. There we go. And it prints a new bar. So everything inside of this one bar is all of this. That's your refinement process. Guys, that's where the amazing magic of what we do comes in. I don't have to wait for the wick, Steve, sorry. I can anticipate the pullback to the area at those triggers. That's the recipe. And if I got in here, I made my $300. I'm done. I'm out of that trade. Pretty cool, right? But it takes study. It does. It takes some time to make this second nature. So here we go again. I've got odds favorable momentum. I've got the potential to break. I can already look over at my triggers and I can see the areas inside of them. So if I get a pullback, Steve, it's likely to bounce and continue down somewhere in this range. It does. It takes study. The first thing that you have to do is you have to know the rules, right? You have to know what momentum is. You have to know what it looks like to have a clear path. It will likely reverse sometime. Look at all that. Look at how much the market fluctuates. This volatility is amazing for us because the more it fluctuates, the more opportunities it creates. And you're absolutely right. Blue Pearl, if it doesn't hit my order, F it. That's not my trade. I don't chase the market. I refuse to chase the market. My trading plan is so solid, and I have so much trust and faith in my trading plan that I will never, ever chase the market. I don't do it. I get in on my terms because my terms have been proven to win more than they lose. So until you do the study, right, until you go through and see 400 pictures of people getting in on their terms, let's look at this. Here, I'm going to slide this off so I don't have to go back and forth. This picture says perfect trend trade long. Let's see what it looks like. Just for poops and giggles. It was momentum, it was the potential to break, and it was a pullback right to the area inside of triggers. Pretty cool, right? This is from 2022. And there's the same pattern. So let me go to another one. Other direction. Let me figure out where his charts are. Okay. There's momentum. Haven't reached the area. And it pulled back directly to resistance inside of triggers. So that's the exact same pattern. And I'm telling you, so Stephen, one of the ways to slow the market down, to help anticipate, is go look at these pictures. Perfect short entry, perfect long entry. What's it look like? Momentum, potential to break, pull back to area inside of favorable large triggers. It looks exactly like that one. It's the same pattern. So all we're doing is we're learning patterns. And the more you study it, the slower the market appears to move. The more you study it, the easier it becomes to anticipate. It wouldn't be fair to put the pressure on yourself to be able to anticipate these patterns until you've committed a little time to study. This is why I don't chase Blue Pearl. They came back for me, didn't they? Momentum, potential to break, area inside of triggers. I got my reversal bar. I have virtually no risk. I actually got in a little late on this one. Gary, I thought NASDAQ was closed. I may be wrong. Does that make sense? Do you guys see it? This is kind of what it looks like. Momentum, potential to break, pull back to resistance. Does it guarantee a winner? Absolutely not. But what it does is it gives me a fighting chance. That one bar that told me to look for an entry, I'm still in the middle of the bar. I don't know if it's going to go up or down, but I was able to take the guts of that bar and pinpoint an area right inside of triggers, and I'll be damned, that's right where it appears to be bouncing. So you've got to learn the patterns. You've got to figure out what it looks like to take that trade. And then once you figure out what it looks like, you just have to wait for it to set up. Does that help a little bit, Steve? And I know that it takes a while. That's the mid band. The midband runs through the purple line right here behind it. Those purple dots. Yeah, those are small swing 1-to-1s. Those don't come into play so much. John Novak has them incorporated into every workspace because there's clients that use them. I tell you guys, don't worry about them. Entries come from fibs, midbands, or yellow 1-to-1s. Did you watch that indicators video yesterday, Steve? Which line? Right here? So, guys, one of the things that's so important to me is that you can take pictures and post them in the room, because what we've done a lot of today is guessing what you guys are looking at. But if you show me the picture, hey Mark, check it out. You were stranded 43 miles away. Oh, I like the good deeds. I like the good deeds. I need you, your friend was, I need you guys to show me what you're looking at instead of trying to make me guess. Because we literally will burn 50 minutes a day on me guessing which line you're talking about. Or you could just do this. Hey Mark, the hell is that line right there? What does this line mean? What is that line, Mark? What are these small triggers? What are those triggers? That's when it gets easy. So Blue Pearl, the 5-1, has 3 trigger lines. The 5-1 will have, let's dissect it. It'll have small trigger lines, and those are the lines that you're going to use with the large to define momentum. It has large trigger lines, those are smooth, and then it has the synthetic trigger lines, and those are the ones, watch this. If I put a box around the synthetic trigger lines, those are the large triggers from the large chart. And then if I put a box around the large triggers, you can see how they're down here. So it's that combination that gives us a little bit of accuracy there. And notice that the market just pulled back to resistance right inside of triggers. And I'm about to kill my NinjaTrader by doing that. So guys, I'm going to reload my NinjaTrader real quick. Nope. So Steven, I really want you to watch this video. It's going to help a lot. But we'll go through. I'm going to take a break because I'm an hour late on my break and I really have to pee. When I come back, we're going to do a roadmap. We're going to do a 100% what the heck am I looking at? Sound good? So I'm going to open up crude oil and make sure that I close my positions. And I'm going to build a roadmap, and we're just going to draw it out. And we're going to label everything, and I'm going to give you guys all the pictures. So I'll be back in about 5 minutes, guys. Go stretch your legs. All right, so let's draw a roadmap of everything that we're looking at on a large chart. Let me find a picture that has a representation of everything. I think this is going to do it. All right. So I'm going to give you guys this one when I'm done with it. Actually, I'm going to give it to you in a couple parts. So here's the first one, guys. These are trigger lines. Trigger lines are on every chart that you're going to own. There are small triggers, there are large triggers. Small triggers are a fast-moving average. They're the same no matter what time frame. Large triggers are a slower moving average. It's the same no matter what time frame. Small and large work together to define momentum. And then we can talk about areas. And honestly, I've got this picture. So these are your areas. Magenta highs and cyan lows. These are divergence. These will print if there's a loss of momentum. You've got Fibonacci resistance, Fibonacci support. You've got yellow 1-to-1s, and you've got the midband. And if price is above, it may act as support. If price is below, it may act as resistance. So if you're going to be successful with the software, it's pretty important that you understand these. And you know what? Let me change areas to areas large chart. There's a couple ways. Actually, these areas are consistent no matter what. What you can do, Steve, sorry, I keep reading the name. Hopefully you can see that. So on these pictures, you can click on it and you could drag it over to your computer if you wanted to. You could put it in a file. You can click on it and it'll open it, I believe, and then you can right click and save it. Let's see what's under the more. Edit message, reply, forward, copy text. Does it? Oh, it does. It's the M that I see. My bad. Remember, I'm human and I'm old. And I'm looking at stuff. So you can just right click and save those pictures if you want. But guys, these areas, these lines are the same, whether it's a large chart or a small chart. Triggers are always triggers, and 1-to-1s are always 1-to-1s, and fibs are always fibs, and divergence lines are always divergence lines. So this is a great roadmap, and I gave you the triggers as well. I'm a pup. And then the only difference, guys, the only difference between the small chart and a large chart, oh, man, I just closed out. Give me 1 second. I accidentally X'd out my small chart. The only difference between the large chart and the small chart, the areas are all the same, the looks are all the same. The only difference on the small chart are the synthetic triggers. Triggers. These are the large triggers from the large chart. Synthetically placed on your small chart to increase entry accuracy. So that's it. That's the only difference. But everything else is the same. So there's the box right there. So let me give you this one. And that's really the roadmap. That's the indicator's roadmap, guys. You don't have to know how they're built. You don't have to know what makes them. You don't even have to know who our programmer is. But these things are what we use to identify the advantages to go through. It doesn't save. All right. Do me a favor, Steve. Right click. And click Save Image. Okay. Let me look and see if I can figure out where mine defaults to. I don't know if it saves it into... usually there's a download button. Let me see. Hold on. I'm not a Discordologist. And I don't know if it saves them into Discord. Has anyone stolen pictures from the room? Have an answer for me? Ah, there we go. So it does. It goes right to my downloads. I knew I'd find it. When I go to save it, it goes to my downloads. So check your downloads. Right click, save. And then for me, it goes right to my downloads folder. Awesome. You got it? Yeah, I had to go to the other one from the pop-out. Nothing we can't fix, right? Nothing we can't fix. We just gotta look at it sometimes. Let's look at a couple trades. This is Wayne. And Wayne says, check it out, Mark. You even talked about this one. Odds favorable, everything down, coming from a termination. Perfect entry, beautiful exits. Wayne, everything is perfect. So what I want you guys that are newer and learning this stuff to see, Wayne was new once too. There was a point in Wayne's life where he didn't know what the triggers were, and he didn't know what the fibs were, and he took some time and he studied and he asked some questions, and now he is nailing these exactly as they're taught in class. Wayne, what a great trade, dude. Nice job. And then Rob didn't have momentum, don't have a clear path, didn't trade from an area inside of favorable large triggers. How'd that work? Just curious. He might have done all right. And Steve, remember, as you grow with the software, you'll begin to learn how to hold for bigger moves. You can add contracts. He's just a little bit ahead of you. So Rob, the one thing that I always ask, and I wish you would do, is show me trades from start to finish, right? Show me the entry all the way to the exit. Because all I'm going to do is I'm going to read your charts. I don't even read these, right? I don't have momentum. Rule number 1's broken. I don't have a clear path. Rule number 2's broken. I didn't trade from an area inside of favorable large triggers. Rule number 3's broken. I know. So why don't you like typing it? Do you not like being incorrect? Why do you type it if it's not true? So there's only two options. One, you type what you want it to be so you feel good about taking the trade. I've done that 1,000 times. Or two, you don't understand what momentum looks like. And man, if that's the case, why the hell aren't you stopping me every day when I talk about momentum? Why aren't you saying, you know what, Mark? I just don't think I get momentum the way I thought I did. Can you review it for me? Because I will, because this is always momentum and these are weak-ass triggers every time. And I give you a way to get good at that every day. So just wire in. Did you believe that you had momentum? Did you believe that you had a clear path? That's why you typed it. Because that's the momentum that I talk about every day. Every day I talk about odds favorable momentum. Every day I talk about it has to be a separation between the triggers. That's the only way you can have momentum. So the review is an easy one. The only way you ever have momentum is if there is a gap between the small and large. That's the only way you will ever have momentum. Cool? Awesome. So now you can go through and you can say to yourself, man, I didn't have momentum. All right, that's one advantage gone. I know I'm not taking momentum trades and I don't have rule number 1 for the high probability trend trade. And then once you have that momentum, remember it's a flow chart. You got to say to yourself, do I have a termination condition? Well, termination conditions are the same always. If price reaches an area and the triggers haven't broken, it's a termination. Let me drop that in there. There's termination conditions at a low. And then the same is true at highs. If price reaches an area at a high and the triggers don't get beyond it, it's always a termination condition. No matter whether you think it's going to break, it might break, you hope it breaks, I want it to break, until both the small and the large triggers get to the other side. Where's my picture? Here we go. So here's the one that shows all three. Whoops. If price reaches the area and the triggers are all below it, all the lines of the triggers are below it, it's a termination condition. It is not a clear path. Until both the small and the large triggers get above that line, small and large, both of them get above that line, you don't have a clear path. The in-between phase is if you have odds favorable momentum and the small triggers smash, large triggers haven't made it, that one at least has the potential to break. So there's no separation. I can't call it momentum. My triggers aren't above resistance. I can't call it a clear path. And then just one more thing, man. When we talk about entries, bought the pullback is an incomplete thought. And that's okay. Because we're buying the pullback at the areas inside of triggers, guys. And this is why I think language becomes so important. And this is why I think it's so important for you to take those pictures. And why I think it's so important for you to, that's the wrong one, to write this verbiage inside of favorable large triggers. Because what happens is if you write that every time and you look at those triggers, you are forced to say to yourself, damn it, I didn't get in 2 ticks above the area inside. I'm on the wrong side of the bouncy point, and there's no other bouncy points inside of triggers. Does that make sense, Rob? And it's okay. But this is why we annotate charts, because you have to tell me that you thought you had odds favorable momentum. And then every time we do this, I say, no, that's your momentum. This is a little bit of weakness. We don't have that push. And every time you type clear path. But what happens a lot, and Rob, I'm not saying that you're doing this, so please don't take this as accusational. What I see a lot of people do is they'll say, I got in right here at the area inside of favorable large triggers, because they know that that's the rule. But the triggers are all the way up here, and nobody wants to believe they're breaking the rules. I had odds favorable momentum. Well, you didn't, but you really wanted to go long. Did you see the picture that I dropped in there? Do you save these? Here's the spreadsheet again for you, Rob. I have 56 pictures of what it means to have strong triggers. Every one of them is annotated describing it. I have 29 pictures of weak triggers. Every one of these is annotated describing it, so you never mix the two up. I've done a lot of work to try and keep you guys safe. Rob, almost 80 pictures of what it means to have a termination condition. That's it. So, okay, Rob, if you walk up to 10 people on the street and you get right in their face and you tell them to go F themselves and put 2 fingers in their chest, are all 10 of them going to punch you in the nose? No. But I bet you 7 of them will, right? So if you have a 70% chance of getting punched in the nose, you're probably not going to embrace that behavior. Rob, you've got at the least, a 70% chance of a termination condition screwing up your trade. There it is, even with momentum. There it is, there it is, there it is, there it is, there it is. So what we're doing is we're saying, okay, if my triggers don't break the line, there's a better chance of me losing this trade than there is of winning it. Does that make sense? If I trade without momentum, there's a better chance of me losing this trade than there is of me winning it. And guys, yeah, these are fake. John Novak will never reach out to you for crypto. I don't know what BCS is. What's BCS, Rob? Sorry, I don't always catch the acronyms. Because, okay, but does that make sense? Every one of our rules revolves around thousands of pictures, countless hours of study. And there's some gospel truths, and that's how they become rules. We get the rule of the advantage of momentum. Hold on, let me open this up. We get that rule for the advantage of momentum because we've taken 1,000 pictures and 1,000 different scenarios. And this is the look when the odds are favorable for the market to continue. And Rob, in 1,000 pictures, and everybody in the room, not just Rob, this is the look when anything can happen up or down. So it's not that the market can't continue down, but I don't have the look that's told me through study and all of that time and effort that it's more likely to push down. Does that make sense? It could go down for 17 days with weak triggers. But anything could happen. And then the same is true when we start talking about termination conditions. When this look happens, more often than not, the market stops, creates an untradeable bounce, or reverses. It doesn't mean that it won't break. They break all the time. But more often than not, I'll lose the trade. And if it's weak triggers at the fib, I'm even more likely to lose the trade. So guys, we go through these rules, and all of these rules have been established over an awful lot of study. I hope that makes sense. And this is why we talk about them super basic. Understand momentum and know that it should make you happy. Understand a clear path and know that it creates an advantage. Learn to define your entries, and what you're doing is you're not trading the one time that it blew through. You're not trading the one time that weak triggers pushed it. You're not trading the one time that the area outside of triggers created a bounce in the direction of the trend. You're taking a pattern that has been proven to win more than it loses. And that's what I teach every day. I teach patterns. I teach a pattern that is traceable, that is studyable, that is identifiable, that is verifiable, that is validated to win more than it loses. So you just have to learn that pattern. Whew. All right, I'm getting out from the pulpit. Duplicatable. Did I say that? Thank you, Marlon. All right, Joel. Strong triggers. Potential to break but not broken. Pull back to the area inside of favorable large triggers. First target gets money in the bank. Second target, out at fibs. What a beautiful trade. I love this. This is the 50-50. And notice that momentum is what's pushing it. But we've gone through that process on each one. Joel says, do I have momentum? Yes. Okay, let me look at my path. Well, my path isn't quite clear because the large triggers aren't there. Because this is a 50-50 trade, Steve. This is trading the potential to break, not a clear path. This isn't a high probability trend trade. The entry looks the same. The momentum is the same. The difference is we've sacrificed the clear path. But Joel says with this much momentum, almost a clear path, and this perfect entry, I'm willing to take it from the best spot. I know where my stop goes and it's virtually no risk. And it's hard to stop that freight train. It's hard to stop that momentum. And he carries it all the way up to the fib. I love everything about this trade. But do you notice? He talked himself through each of those rules. He talked himself through his advantages. And you'll get there, Steve. You will get there. I hate being new. I don't know if I'm the only one in this room. I hate being new. I hate not knowing everything. But eventually you get to that point. Eventually you get to that point to where you know exactly what you're looking at. You know exactly what it's going to take. And Jay, I owe you an apology. I missed this one earlier because I think I got caught on a tangent. Exactly, Rob. But there was hope for me. So check this one out. This was momentum. This was the potential to break. And when divergence prints, that's your key, right? That's your key, that I'm sacrificing momentum and it's harder to break an area when you're losing momentum. Jay, you took the JTFI. You just jumped in. That reversal bar was your indication that you should have gotten out, but you held it much longer. And then you got mad at it and you said, well, I'm going to go up even though everything says down. And you got stopped out the other way too. And this is a great example, guys. You have to have rules. Your rules are designed to keep you out of trouble. Your rules are designed to give you that advantage, to recognize that advantage. And if you don't know what it looks like to have your rules met, how are you going to follow rules? Does that make sense? If you don't know what it looks like to have strong triggers, how are you going to be sure that you have that advantage? So guys, if you don't know what it looks like, or even worse, if you keep getting the ever-loving crap kicked out of you every trade you take, you have to put it in the room with it annotated. And Rob, you did a great thing by dropping that in the room. And you said, well, that's why I hate writing. Your writing lets us know that you need to study. You need to study strong triggers and make sure you know exactly what they look like. Steve, you need to look at every picture in this lineup and burn it to memory. And you need to look at every picture of this weak triggers and make sure that you know the difference between the two. But Mark, that sounds like a lot of freaking work. If I'm going to buy the software, why do I have to work so hard? Because we don't tell you when to trade. You have to tell you when to trade. I give you everything you need to learn when the rules are met. So you've got to look at the clear path. Rob, again, what's a clear path? Let's click on it. Let's see. Large and small clear the areas, have not reached the next area. The area is broken, clear path, rule 2 met. And then look at this. Price reached, support, triggers remained above. This is the term, path not clear. That doesn't make sense. Triggers remain below. I didn't change the wording. But that was your look in the last trade, Rob, and it's right there in the spreadsheet that says, hey, don't trade. Even with odds favorable momentum, right, Blue Pearl? If price reaches support and the triggers remain above, it's not a term. It's not a path. So, Rob, fear of missing out is okay. That's a part of life, right? I'm okay, guys. I get the fear of missing out too. I'm not going to lie. And I don't mean to go back and look at this again, but we're going to go back and look at this again. It's okay to have the fear of missing out, right? And the fear of missing out causes you to make choices that maybe you shouldn't make. Guys, I get that. I've been trading a long time and I understand how that works. But this is lying to yourself, whether intentionally or inadvertently. If you take the time to annotate your chart and tell yourself that you had momentum, guys, your brain believes you. Your brain believes you. So don't hate riding odds favorable momentum and being wrong. Recognize that you've got some study to do so that you don't ever try to talk yourself into a trade that you shouldn't be taking. Same with clear path. And Rob, I'm not saying you did this, but people will type on the chart what it takes to enter the trade no matter what the chart says. I've done it. People say, I know my rules say I didn't have divergence, but that wasn't there. Not just up, no. It's separation between the small and the large. Separation between the small and the large. Scissors open. The triggers are up the whole way. Even on the retracement, the triggers are up. But they're only up with strength right here. Does that make sense? That's a great question. Hold on, my triggers are up, right? They're green. Green is up. But I don't have momentum because there's no separation between the two. Does that make sense, everybody? Absolutely, they're up, but they're not up with strength. 100% they're down, but they only had strength for a moment, and it wasn't enough to break the area. Came in, we're stop prints on the chart. Right on. This is strength. This is not. But they're both down. This is strength. This is not. But they're down. They're down for the whole duration. So you've got to learn that difference between the two. Termination all day long until the triggers get above. Then it becomes a clear path. I try to keep things as simple and focused as I know how. But you've got to learn the basic concepts. You've got to build that foundation because then it's just a flow chart. And we've all worked with flow charts, right? If I have this, maybe that. If I have this, then I do that. If this happens, then I look for that. If that doesn't happen, then I have to go this way, and it's either pump the brakes or find something else. So if I don't have momentum, guys, if I'm a brand new user, if I don't have momentum, I'm done. That's it. My rules aren't met. I don't take a trade. If I have momentum, but then I don't have a clear path, I'm done. Rules not met. I don't take a trade. If I have momentum and a clear path, but I don't have areas inside of triggers as a brand new user, I'm done. I don't have a trade. As you grow with the software, you'll know when to make exceptions. As you grow with the software, you'll understand when it's okay to not have the best momentum because you still have a clear path and an entry area. Or when maybe without a clear path, you lean on momentum and entry area and manage assertively. Or maybe even without the entry area. When you have momentum and a clear path, you wait for that up bar, that down bar to get you into that trade because you've got 66% of your advantages. I want you to be able to speak to yourself in terms of advantages. Every time you open a chart, I want you to ask yourself, do I have momentum? No? Damn it. Do I have a clear path? Yes? Okay. Do I have areas inside of triggers? No. Why on earth am I thinking about taking a trade? Does that make sense? I am full on the pulpit today, ladies and gentlemen. I love this stuff because I've made every mistake that you can make. I have tried to bypass every study tool given to me. All right, so Blue Pearl. Where are areas defined? Where do we look for termination conditions? Do you remember that lesson? That's a great question. Do you remember where we identify things? Large chart will define direction, momentum, and terminations. Small chart's an entry chart. That's it. And let me show you why that becomes important. And I've got pictures for everything. I mean, I have pictures for everything. Sometimes it takes me a second to find them though. So check this out, Blue Pearl. And we're talking about right here. Do you see how the small triggers have smashed through? Absolutely smashed through with odds favorable momentum. And that lets me know that these Fibonacci areas have the potential to break. Does that make sense? On my small chart, they really didn't get through. They didn't smash through the area. They kind of gophered, little peeked their head beneath. Didn't smash. So because these are different time frames, that's why we let the large chart lead the way, because this odds favorable momentum, this smashing through the areas, this creates opportunity that I might skip out on if I let the small chart drive it. And you'll see entries on the small chart. Hold on, I know where a great picture is because we're gonna go to a lesson too. There's one time, Blue Pearl, on the small chart that I refuse to enter the high probability trend trade. There's one time where I'll let it be a termination condition, and that is, sorry for the scroll, 3 divergences in the same location, 3 losses of momentum in the same price range. This is the only small chart termination, Blue Pearl. This is the only time where I won't take that perfect entry. And with 1 divergence and a fib, couldn't care less. I take the entry. 2 divergences, not smashing through, doesn't faze me. I'll take the entry. I might even add on to my position. But 3 divergences. This is the small chart telling you what you can't see on the large chart. This is the only time I won't take that last trend trade because this says the market may push up higher. And the same is true at the high. So I may be bouncing off of a 1-to-1 to get my entry. I might even be bouncing off of a fib to get my entry. But unless there's 3 divergences, if I have momentum, if my path is clear, man, wild horses will not keep me out of that trade. Does that make sense? And that gives a good example here too, is that might have been the perfect trade. Don't let one little line on a tiny little fast refinement chart talk you out of it. Terms happen on the big chart. And then this goes back to, but I've seen it go through the areas, Mark. I've seen it go through the areas. I've seen weak triggers push through. I've seen strong triggers push through. Guys, this was one day up to 11 a.m. And it was, I think, 26 times the termination conditions worked and would have produced a loser. And 7 or 8 times, 6 times that you following your plan bummed you out because it broke anyway. This is how the rules came to be. Nexgen has been doing this for 27 years, guys. I've been teaching for the last 4 or 5. And I can tell you, keeping it simple is where it's at, man. Keeping it simple is where it's at. This has been a good day. I hope you guys are learning some stuff today. I hope there's a little clarity coming in. All right. Where did you get in? You got in at 74.15. And oh no, you entered at 08, you got out at 15. Is that the math, Kurt? Kurt's like, Novak, I know you're not a math guy. Let me make you feel bad about your inadequacies. Not really. Okay. So you entered the market right here. And you sat through all of this off of a no momentum at a fib. They are. All of these pictures people take are of their own screens, Steve. Whether they're simulating or whether they're live. You held through all of this and then you exited once you got back above the fib. So congratulations, Rob, you made money, right? I love it when you guys make money. I get giddy about it. But this is the first trade that you've showed me today, and you're down. And you've got a negative number, at least $68 worth on the micro crude here, which means on a full lot you're down 680. And the only thing that you showed me was your kick-ass $14 winner. Which means that you were down $82 before this trade. And I'm not beating you up, and your trading is your trading. And guys, this is one of the things that I can't stress enough. This trade that breaks rules, that produces money, is going to make you believe that you're doing something right. Guys, every trade wins at least once. Every bad trade, every dog finds a bone, broken clock is right twice a day, whatever cliche you want. My goal, my hope, Nexgen's hope for you is consistency, is to be able to produce results every day. Because you have and believe in a pattern that has been proven to win more than it loses. The traders that I work with that are the most consistent have 1 or 2 trades, and every entry they take looks exactly the same. Every large chart, when they take that entry, looks exactly the same. Their management is clear and defined on each and every trade. And it's the people that can do nothing that typically do the most, that have the best results. So if you show me a trade, it doesn't faze me. Do what you do. Be who you are. I love that. But I'm going to point out if you don't have momentum. I'm going to point out if your path isn't clear. I'm going to point out if your entry is where the market shouldn't go. And I'm going to point out if you left an awful lot of risk. Because even if you don't want to hear it, I want you to find longevity. I want you to find consistency. And guys, I take it personally when people walk out of my class and don't think they can do this. So I need you to tell me if you need help so that I can help you. Because there's nobody that I can't fix. I can give you everything that you need to be successful. The only thing that I can't do is provide you a work ethic. The only thing I can't do is make you take pictures and annotate charts. The only thing I can't do is make you post in this room. I can't make you use the spreadsheet, guys. That's on you. You have to decide whether or not you just think this is neat and fun like a video game, or if you really want to quit working and make this a full-time career. Odds favorable momentum? No. Clear path? Yes. Entry after confirmation bar. So, Kurt, you're saying that with a clear path and everything up and coming from a strong bottom, you're not just going to arbitrarily jump in without momentum, but if the market goes in the direction of everything good, you'll get in with confirmation and hope that it continues with everything good. I love this, Kurt. So guys, sometimes your entries aren't perfect. Sometimes your rules aren't met. You'll find a way to capitalize. Kurt did, and did it beautifully. And notice that he gets paid in the middle with nothing going on, because Kurt knows that his job is to make money. And then his second exit is right before some trouble that he defined. Great job, Kurt. Awesome trade. This bump at 74 made me think it was odds favorable momentum. Do I need to be more patient? So at 74.14, 74.14, yeah, you had some momentum there. Absolutely you did, Rob. And you jumped in, hoping that momentum would carry you. I like it. I got no problem with that. What you didn't do is exit that position when the momentum was gone. And then you got in again, I'm not sure why. And you're just hoping. And I like it. That's okay. So check this out. Let's take a page out of Kurt's book. You have your mid-band down here, right, Rob? And Rob, I know you, and I know that you're good at doing this. You know the mid-band might create a bounce. Fair enough, everybody? That mid-band could create a bounce. I know that's one of my areas. But it's not inside of triggers. So I've got this little conundrum going on. I'm like, man, I see areas, but they're not inside of triggers. Rob, this up bar, and I like this. This is a great lesson. If this market is really going to go up, if this market is going to go with that momentum, if it's going to go with that direction, you're going to get one of these, Rob. You're going to get one of these up bars. You're going to get that reversal bar. Well, then you need to do some study and decide when it's okay to take it, because I don't have any rules that say do it. But what I do have is if I'm going to break my rules, if I'm going to hope the mid-band holds, instead of have it inside of triggers and my rules met, this up bar, Rob, says, hey, Rob, guess what? It's going in the direction of the large chart. It's going in the direction of that momentum. It's going in the direction of that path. This right here says go. So instead of I hope this holds, or I'm going to jump in hoping, or I'm going to just wish shit would work out, you can literally say, I'm going to force it to bounce and go in the direction of my trade. Does that make sense? And look at this. If you get in on that reversal bar, it's 5 ticks better than you just jumping in. It is 5 ticks better. And here's the great part, Rob, is your rules say my stop goes 2 ticks below that reversal bar. So now you've established risk. And you've gotten confirmation. Does that make sense? My first hour is designed to give you guys the best of the best. My first hour, the teachings in this class is designed to give you the highest chance of success. Guys, your entries are rarely going to be perfect. But if you understand the rules, so here's a great example. I have a clear path, but I don't have momentum. I think the fib might hold, Rob. I think the mid-band might hold because you see it a lot. Why not force the market to give me a confirmation bar? Why not force the market to get me into that trade? Does that make sense? Did you buy the mid-band because you see it a lot? because you don't have momentum or a clear path, make that market do what you need it to do. And once you understand your rules, guys, you know when you need that little confirmation. Until you understand your rules, you're going to flail a little bit. So I have the clear path, but I don't have momentum. I have areas that might stop it, but I don't know. I'll force it.
Order submitted.
Come get me.
Order canceled. Order
I'll tell it. Make that reversal bar. Pay a little bit. No, I'm not saying pay attention to the reversal bar. I'm saying know your rules. And if they're almost met but not quite and you need a little confirmation, force it to give you a reversal bar in the direction of your trade. Because, I mean, that was a reversal bar. You would have lost, right? Rules weren't met. That was a reversal bar in the middle of nowhere. That was a reversal bar. Look at all those reversal bars. Holy shit. So you at least have to have some idea of what it is you're looking for. You've got to be able to look at your chart and say, I have this, I have that, I have this. I'm just missing this one element, but I feel pretty good about the likelihood of it going up. Let me force it to go up. But here's the deal. All of you guys, if you're not in that position where you can do it and do it quickly, reversal bars are nothing. It means the market's going the other direction. You've got to know the whys. You've got to know what you're looking for. And this is the part that all of you hate. Mark, I want to be a day trader. Mark, I want to make money. Mark, I want to be in the market. Don't call them out, Wayne. Please. Because right now there's 5 people that are going to jump in because Wayne said he's short. So guys, I always ask, please don't call your shots in the room. Take a picture, tell me why, we'll discuss it. But we can't have anything that even resembles calling trades in this room. Thanks, Wayne. And my brain says, why the hell would you short here? You're directly into every area of support. The large triggers are way up here. The smalls aren't even outside. Terminationville. Population U. And I don't know what's going to happen. I never know what's going to happen, but we're heading into lunch break. So for my newer people, Pardis, Blue Pearl, Steve, who else is new in here? Pug. I'm just going to call you Pug. NYC is too hard to say all the time. Who else is new in here? Help me out. KRC, where you at? Guys, I want you to remember, one day at a time. One day at a time. Learn your rules. Learn your rules like a scholar so that you can break them like an artist. Have you ever heard that? Learn your rules like a scholar. Know your rules like it is the basis that you live life. When did you post it? I got one of them, Jay. Hold on, I'm scrolling up. And guys, always do that. If I ever miss a picture, make sure you tell me. Don't let me get away with that. There it is. I'm sorry, I did not. So let's talk. No, we did see this one, didn't we? Good momentum, triggers broke trouble, went short, divergence printed, market lost, it's a loser. Absolutely. It's another one of those 50-50s with divergence, right, Jay? It's another trade that only had the potential to break. And guys, the KISS plan says divergence kills it. This was the first one. I think we did the other one. Hold on. Either that or you posted the same picture twice. No, this was the other one that we talked about. It's the same look. Divergence on a 50-50 and killed it. And then you tried to go long because you said, F that market, give me my money. And it killed you the other way too. This is 2. These are the 2 that I have. Are there more? Is there a third? No worries. Guys, don't ever let me get away with not seeing your pictures. Sometimes it's easier just to repost them and say, hey, look at my picture, dagnabbit. I don't ever skip them on purpose. Don't ever skip them on purpose. But the cool... So this one... You too, Kurt. Are you a Penn State fan? Got a really good friend of the family. She plays basketball for Penn State. So I am a Penn State fan adjacent. Oh, right on. Burr. It's too cold up there. Trying to see where you entered on this one. You entered at 37. It's cold here too. We're in the 30s, and this is Texas. I'm a wuss. I'll admit it. Really? Single digits with the wind chill? They sucked up last night versus the Illini. Our dad is a Illini alumni. He got his engineering degrees there. So in that case, I would have had to root for Illinois. So Jay, this one you jumped in at the bottom of the move. 26 without the wind chill. Brr. That's Maryland? I don't know how you guys do it up north. I'm not going to lie. I don't know what